Hello, ladies and gentlemen. Welcome to the first episode of what TJ the Wheel Deal and I are calling Wheeling Options. This was an interesting podcast idea we had over Christmas break. We were like, you know what? We're thinking of starting something together, and it is manifested into Wheeling Options number 001. Thank you all for being here. I'm going to give it to TJ and kind of give him the floor on why we started the podcast, what his intention is with the podcast, and then we're going to get into our first topic of the day, which is an introduction to all things cash secured puts. Go ahead, TJ.
What's going on, Amit? First of all, Happy New Year to you and your channel here. I hope everybody's doing well. The main reason for the podcast, Amit, is because I want to show a handful of people everything that I know about selling options, because I've been doing it at a pretty high level for a couple of years now. Mainly this last year and a half, dude. Like I've really immersed myself into all things cash secured puts, covered calls, and the art of the roll. And I want to leave my mark on YouTube. I'm not really able to grow my personal channel. So I was like, if I can go on a bigger channel, and I took a special interest with you. We've had several conversations off camera, and I want to see you win. So I'm like, the easiest way for me to see you win is to help you win. So I'm like, I want to show Amit how I view selling cash secured puts, covered calls, and utilizing the art of the roll, because you're 26 years old. How rich can you be at the age of 48 like I am? And I would love to sit back and just watch you win and watch several people win. That is essentially the reason why I wanted to do the podcast, is because the more you give, the more you get, ladies and gentlemen. The more you give, the more you get in this life. I don't have anything for sale. I'm willing to give my knowledge away for free. I am writing a book that will be for sale, but for like $10. I mean, nothing crazy, but I'm saying I want to show people how to win. And this is the only thing that I've ever been able to do consistently in the market that yields pretty favorable results. Let's get into it. Amit, it's your show, my man. I've taken my Adderall. I've got my ADHD elemental P under control. Not going to interrupt you, bro. I'm going to do my best to be a pretty good co-host here.
When you said that, I asked him off camera. I was like, "Do you actually take Adderall?" Because I don't know.
I should.
I'm super excited for this because I am also a less than a beginner's novice when it comes to options. I know a little bit of stuff here and there, but at the end of the day, I know nothing compared to you. And so this journey, this podcast is going to be a journey for me. It's once a week. So we got 7 days of content of things going on in the markets. And then on this podcast, we're going to take some more macro level concepts and then break down with live examples. The really good thing about this podcast, for those that are listening right now, TJ is not just some schmuck that does options. I mean, he manages a decent amount of money, and by decent, I mean several millions. And as a result of that, he's playing with big numbers. He's made big mistakes. He's had big wins. And as a result of that, you're actually learning from someone. If you know nothing about options, you're learning the psychology from someone who actually does something with options. And as a result of that, I think that's also why there's going to be some firsthand experience on this podcast just once a week for you to get a better understanding of options. Cash secured put. Well, so we're going to talk about that, but selling options versus buying options. Let's start with that. TJ, what is the difference between selling an option? Actually, let's get even more elementary. What is an option? And then we'll go to what's the difference between selling and buying. Go ahead.
Right. So an option is basically an agreement between a buyer and a seller to either buy 100 shares of stock or sell 100 shares of stock at a specific price on a specific date. So you have components of a contract, of an options contract. These are terminology that you're going to have to learn, and we're going to talk about them along the way, right? Because it's going to be a long series,
right?
Hopefully, if we get the right feedback. So the components that you're going to get familiar with are things like a strike price. That is the price that a buyer or a seller are agreeing on to either buy or sell 100 shares of this stock. That's the strike price. The expiration date is the date that the contract would terminate, right? Because you have the day that you sell the option or buy the option, and then you have the day that it expires. And you're familiar with this terminology a little bit, because you've entered into some debit spreads before, correct?
Correct. Yep.
And then the other thing you're going to hear me talk about a lot is premium. There's a difference between being the gambler and being the casino. We were all in Vegas for your birthday in October, correct?
Mm-hmm. We were.
You know how beautiful the Aria was? Did you really look around and take it in, Amit?
The Aria was beautiful. This is one of the most beautiful hotels I've been.
It was. Do you think that they built a hotel that beautiful because people go there and win a bunch of money?
Probably not.
No, it's built upon losers, right? It is. So that is the core difference between buying options and selling options. Is the seller is the casino and the buyer is the gambler. Now, granted, there's buyers that can make a lot of money at a casino, so to speak, but they're few and far between. So I took the path of least resistance, so to speak. It took more capital because I had to put up a lot of money to be able to buy 100 shares. That's the big caveat to this whole thing, guys. If you want to control 100 shares, it's a lot cheaper when you're buying options. If you want to commit to either buying or selling 100 shares, you have to either be able to afford to buy the 100 shares or already hold them in your position. So that's the big caveat, is it is capital intensive because we're dealing with 100 shares of that stock. So we're not going to be wheeling NVIDIA on this channel, because that even on the channel that I advertise on YouTube all the time, like that one's not even big enough to deal with NVIDIA, because you're talking about a $50,000 position, right? 100
just off one contract, right?
It's just it's not feasible. You got to stay in your financial lane. So anytime I look at a share price emit, I always multiply that times 100. And then my rule of thumb is the rule of 5. Is, can I afford 500 shares of that stock? If the answer is no, I really can't afford to be wheeling it.
Right.
Because you're going to be wrong a lot. So you got to be able to afford to be wrong. There's a lot of people that get into situations when they're selling options and they can't afford to be wrong. And I'm like, dude, if you're that sure, why don't you put up less money to make more and just buy the options? Like I put a quote and I want to put it on a t-shirt. If I knew when the hell the stocks were going to go up and down, I wouldn't sell options. I would buy them because I could make a lot more money,
So you've been a seller versus a buyer of options because what exactly is the reason you've been selling versus
the reason is because I'm going to win a lot more consistently. It's a defensive play, right? Because I couldn't pick an entry point to save my life. Like I'd buy shares and it seemed like the stock gods were against me and these shares would just tank. And then I'm like, okay, what am I going to do? Well, I'm going to average down. I'm going to DCA, whatever, right? I'm going to buy more and buy more and buy more and hope that eventually they go up. But it's like I felt like I need that to happen in order to make money. But then it's harder than that. It's like, okay, cool. Let's say it's Palantir, your favorite stock. And you bought it, you started buying it at like 25 or whatever, and you bought it again at 20, and then you load it up at 7 or 8. It's a big old journey. And you're just essentially holding this big old bag of Palantir. You're building up your Palantir nest egg, right?
Right.
So the only way for you to ever realize a gain in Palantir is Palantir has to go to 30, 40, 50 bucks. And then you have to have the courage to exit that position to realize that win, correct?
Right.
So it's a lot of opportunity cost there, because that could take that investment thesis 5, 10, 15 years to fully play out for you. A lot of ups and downs, because you've been in the stock market long enough to know that stocks go up, down, sideways all the time for no rhyme or reason usually. So I needed income. Like I'm like, okay, I got some capital, I've got some knowledge, but how can I consistently bring some money through the door so that I can afford to stay in the game? And what I mean by staying in the game, guys, is I can afford to let this investment thesis play out if I was bullish on a company long term. So Palantir, if we want to stick with Palantir, just, because it's friendly for your channel, your audience, right? I know that I want to be in Palantir till at least 2030, but I needed to be able to afford to be in Palantir. So I needed to generate income along the way so that my core investment can stay intact, because life's going to happen, guys. And you're building up this position, and I've heard it so many times. It's happened to me. And before the investment thesis plays out, you end up selling out of this position. And how many people do you know that have said, oh, I owned Apple in 2008? I know I owned Apple, and it's always past tense, right? I owned Apple, I owned whatever, and they don't own it anymore. So they're basically talking about all the money that they left on the table. Well, what if you could be collecting some premiums along the way, so that maybe you wouldn't have to sell out of your core position? You can give yourself a better chance to realize the big win, which is the capital appreciation. And that's by selling.
So that begs the question of one of the first option strategies we're going to talk about today, which is selling a cash secured put. And so here's my first question for you. When most people think of the word put, they think of bearish. You think the stock's going to go down, and you would do that if you're a bear. What is the sort of basic thesis of selling a cash secured put, and why is it not a bearish option strategy?
Sure. So if you allow me to share the screen, I've already pulled up some definitions. That way we give people very accurate data. Fair enough?
Okay, well, let's do it. Let's do it. There we go.
Okay, super. So let me scroll a little bit down. Here we go. So guys, the cash secured put involves writing an at the money or out of the money put option and simultaneously setting aside enough cash to buy the stock. The goal is to be assigned and acquire the stock below today's market price. Whether or not the put is assigned, all outcomes are presumably acceptable. So we can go ahead and close that out a bit, and then I'll walk y'all through it. But let me, I just want to give them. Here's the thing: you're going to pick a stock that you want to own. And then after doing all of your homework, but let's just focus on Palantir. That way we stay on Palantir the whole time. Fair enough?
Yep.
Is that cool?
Yep.
Or we can do something else.
Let's do it. Let's do Palantir.
Okay, Palantir. So you've been in Palantir long enough to know that $15, if you're just starting now, as good as the story is, they're GAAP profitable. They got $3 billion in cash, very little debt, contracts not for days, months, years, but tens of years, right?
Yep.
Like these guys have contracts, and then maybe they're not growing the customers that quickly, but their product is so sticky that the customers that they have keep giving them more money year over year over year. That's essentially the bull case financially for Palantir, correct?
Yes.
It's very hard for them to go out of business because they have a pristine balance sheet.
Correct.
And they have a way to generate monies, even with the money they have on the sideline. They have a way of investing those monies, and it's just like, holy cow, they return pretty good money to the investors that way.
By the way, I love how you say monies with an S. It gets me every time. I'm just
they got a bunch of money.
Like it's never singular; it's always plural. Monies. That's what I'm talking
about. $3.1 billion worth of monies, Amit. It's crazy, bro.
I love it.
But anyway, so you take a stock like Palantir, your beloved Palantir, and you're like, hey, I want to build a position in Palantir, but I need to get paid some cash flow along the way because I'm just not in a situation where I can just park money here and I can let the investment thesis play out for the next 10 to 15 years.
Correct.
Because I do this full time. I don't really have another source of income. So I look at the market with a different lens. You follow me?
Correct.
Like I have this certain amount of money to work with, and I need that money to go generate me more money because I have to extract some of those monies to live. So I can't just buy, hold, and hope. That is not an ideal strategy for me. So that's just to keep everything into context. But you take Palantir and you're like, hey, it's trading at about what, $16 right now, give or take?
16 even. Yeah, let's say 16.
So we can agree where we both went to school. I went to the University of Texas, you went to Rutgers. We can agree that $15 is better than 16.
I would say so.
It's a better entry point, correct?
I would say so.
So what you do with Palantir is you say to Mr. Market, hey, I've got a $1,500 bill here. I'm willing to buy 100 shares of Palantir at $15, and I'm willing to go as far as setting it aside in escrow, if you will, which is a trust account. If you will pay me some money to do so for the next 7, 10, 14, 30 days, 365 days. There's so many expiration dates out on the option chain, and we'll look at those in a second. So essentially what you're doing is you're saying, hey, I have the cash to buy 100 shares of this stock at 15, Mr. Market. Do you want to play ball? Yes or no? So we look at the options.
Which would be 1,500.
Correct.
Right.
So you have $1,500 to buy 100 shares of Palantir stock at 15. That's the math. You follow me?
Right.
So now the thing is you don't have access to that money anymore. So it stands to reason, Amit, that if you're going to put the money on the sidelines, you can't touch it anymore. It's spoken for. It stands to reason that you deserve to get paid a little bit of money up front for doing so. Yes or no?
Correct, because you're collateralizing that $1,500 that you're giving away essentially. So
you deserve to get paid up front, and that's income. So the beautiful thing about the premium is it's paid to you up front. And no one can take that premium away from you unless you relinquish it. And
now who's giving you the premium for you to be like, how does that magically be
the gambler, the buyer of the option? So here's the difference between a seller and a buyer. A seller is willing to commit to buying these shares at a certain price on a certain day, because they're getting a discount in comparison to today's prices.
Correct.
The buyer thinks he knows that that's going to happen during that time. It's like they have this crystal ball. They talk to Madame Cleo, and they're like, hey, man, the Green Lantern spoke to me. The Magic 8 Ball spoke to me, and it said Palantir is going to dip or whatever the case may be. So I want to buy insurance. They're essentially buying insurance on their shares because they're currently selling at 16 and they might think, hey, it might drop to 13. I have this sucker. All I got to do is pay him a little bit of money right now. And it ensures that I can sell my shares at 15. And if it drops to 13, he's stuck holding the bag at 15. You follow me?
Correct.
So that's why those buyers exist, because they're buying insurance on their shares. And you're essentially the insurance company providing the insurance.
So the buyer is saying, all right, I think Palantir is heading to $15. Right now it's at 16. So I'm going to buy a put. And if Palantir gets there, I will have some upside on the put that I bought, which is a bearish strategy. And really, people just use it for protection, hedging, things of that nature. The seller is saying, if it gets to 15, I'm going to take the premium that you paid to buy that put. I'm going to take it. And if it gets to 15, I will be assigned those shares, which I will take those shares if I'm bullish on the company gladly. But if it doesn't, I get to take your premium from you and I get my collateral back, meaning the $1,500.
So the premium is paid up front.
Right.
So as soon as you collateralize those shares and the contract is filled, if you will, that premium is now a part of your brokerage cash. You could literally withdraw those monies immediately and go to the movies, go whatever you want to do, Chipotle. There's this big channel, Invest with Henry, and he always uses the Chipotle example. So you can go to your Chipotle, buy yourself a burrito, do whatever the hell you want to do. It's your money.
Right.
And now we're just waiting for the contract to play out. So one or two things is going to happen, Amit. It's either going to be above 15 on expiration date or it's going to be below 15. If it's above 15, they're going to release your collateral. If it's below 15, they're going to put those shares in your account. That's why it's a cash secured put.
Right.
And they're going to keep your 1,500. You're going to be the proud owner of those shares, Amit. But here's the downside. If Palantir is trading at $10 a share, you're in the whole $500 in that contract. You could have bought them on the street corner for $10 a share, but instead you entered into this commitment to buy them at 15 because the premiums were real juicy. So you have to be real careful not to get premium drunk. You don't want to just sell a cash secured put to collect premium. You have to be okay with the possibility that these shares could drop a lot lower than your agreed upon strike price. You have to be okay with that. Now, there are ways to maneuver out of the contract. We'll talk about that a little later on, but not to confuse anybody. Whenever you have a cash secured put, I always like treat it it gets in stone in my mind, right? Like if I walk away from this contract and I log onto my account after expiration, I need to be okay with whichever outcome. It's either above my strike price or below the strike price. I either own the shares or I don't own the shares and I have the $1,500 back into my brokerage cash. You follow me?
Correct.
If you're not okay with that outcome, you probably shouldn't sell a cash secured put at that strike because then you're just not really comfortable.
Okay, so I have a bunch of questions, but I want to summarize everything we talked about so far and let me know if what you're saying is, if I'm saying this correctly. Palantir's at 16. I would love to have Palantir at 15. I say, instead of waiting to buy Palantir at 15, I want to get paid to wait, which means I want to get a premium. I enter into a cash secured put. I mean, let's look at it right now. We're going to go to Robinhood.
I'm going to pull it up in a second, Amit. I'm going to pull it up in a second and we'll show the example.
Okay, cool. So I'm just going to look at what the actual premium is going for, and then you got it right there. There you go.
Yeah.
You got it.
So I'm going to walk y'all through this example, but summarize it first, and then I'll show them the example.
Okay, so then I want to get Palantir. I may be getting a 4 or 5% premium. So I say, all right, Mr. Market, I'm going to give you $1,500 for one contract, 100 shares times $15. That's how we get 1,500. You're going to take my 1,500 till January 24th. That's when the contract will expire. And for my 1,500, I'm going to get a premium. Maybe it's $40, $50, $60, $100, whatever it may be. It would be, if it's $150, that would be a 10% premium on the 1,500. That would be nice. Usually it ranges around 6 to 8%. I get that premium. And then on January 24th, if Palantir is at least $15.01, I get to keep that premium I got and I get my 1,500 back. If Palantir is $14.99, I have to buy those 100 shares at the price I asked for them at $15, but I get to keep my premium. Now, technically, if you take the premium plus the amount I collateralized until it gets to a certain level, I am kind of break even on the shares because my cost basis is actually the premium plus the 1,500 divided by the 100 shares, not just $15 a share in and of itself, because I did get a premium.
Right.
Okay, cool.
Let's show them an example, and I think it'll all come together for them. Fair enough?
Yeah, so real quick, let's just do this question by John. He says, even if the price drops, aren't you still getting the premium? So if I'm investing for 5 years, the downside for requesting the premium is a lot lower. The downside for requesting the premium is a lot. Well, that's if it drops substantially below. That's TJ's point. If it gets to $10 and when you have 15, then yes, then the downside is there. But that's based on timing it, and no one can really.
But keep in mind, if you own the shares, you're already susceptible to that downside. Or
that's a good point. That's a great point.
So I'm only selling cash secured puts on stocks that I'm already legitimately long on psychologically.
Correct.
Or I already own another lot of shares. I'm just trying to add to them at a better price than current market value. If that makes sense.
Right. 100%.
So I've already accepted the Palantir could go to zero, as Matt Money says.
Right.
I don't think it's going to. That's if I did, why in the hell would I even be in the company? You follow me? Like, I mean, that's silly. We're obviously doing it on stocks that we're ultimately bullish on long term, but short term we could be a little bit bearish. So why not try to get a better price?
Right.
Because we're bargain hunters. Doesn't everybody want a good deal?
Yeah.
A cash secured put is just an opportunity to manufacture your way into a good deal.
Real quick from Brett, when you put the money in escrow, do you still qualify for the cash yield? On Robinhood, at least no. When you give that money to Mr. Market, that money is stuck forever until the contract expires. So
correct. Another because I know for a fact that Charles Schwab will. I'm actually fighting with Charles Schwab right now because I want to qualify for it, because they told me that since I sell cash secured puts on margin and I exceed my brokerage cash, that I sacrifice the monies that they would pay me for that on that interest. Because there's gimmies and gotchas with everything, but I'm trying to clear it up, dude. Because with the amount of brokerage cash that we have, they were talking about an extra $50,000-$60,000 a year. I mean, what could that do to your lifestyle? You know what I mean? So it's definitely something that I want to be a part of, because Robinhood, as beautiful as the app is, they do not do that.
Right.
They're not going to do it. So let's go through an example here, Amit, and then if I need to clear anything up, we'll go through it. Fair enough?
Fair enough. Let's do it.
So we got Palantir right here. So
first of all, I love that you casually have 500K in the Robinhood. You know, just casual things. Just
so this is the current position, right? So we've got 3,000 shares in my beautiful wife's account.
Oh my God, that average! It's
and
so
she's
beautiful.
got an average cost of $8.68. So we've told Mr. Market, hey, Mr. Market, I'm willing to buy more shares. So we entered into these contracts. I don't know. It'll tell you right here. So I'm going to walk y'all through the dynamics of some open cash secured puts, and then I'll walk y'all through the example of selling one at 15. Fair enough?
Fair enough. Let's do it.
Okay. So right here on 12/28, I entered into a contract to buy 1,000 more shares of Palantir, 10 contracts at $17.50, and they paid me money to do so. They paid us $72 in credit, or 72 cents times 100. That's how you get to the $72, and it's 10 contracts. So that's how we got the 720. There you see the 720. You follow me?
Yep.
So here's the gimmies and the gotchas. The gimmies is the 720. They gave it to us up front. The gotcha, if Palantir goes to $10, don't go crying home to mom. You know what you signed up for. And I sent you an email when I was doing this on the bigger account, and I said, Amit, I am determined to push the price of Palantir down to a reasonable valuation. Do you remember that?
It wasn't an email, it was a text message.
It was a text. It was a text. And I said, we're pushing it down because it's overvalued. You know it, and I know it. So once I enter into this contract, the stock market gods hate me, bro. They hate me. So they're like, this thing is going to go down, and now you're going to have to manage this position. So I'm going to show them the good, the bad, the ugly, and the indifferent. So what's the good? The good is the $720 they paid us up front. What's ugly is now we have an agreement to buy these shares at $17.50, and Palantir now is at $16.10. So I could go buy them in the open market right now for $16.10. Instead, I'm contractually obligated right now to buy these shares at $17.50. So it stands to reason, why don't I own these shares yet? Is because the expiration date is not until 1/19. So that creates what's called extrinsic value in the option. Are you familiar with intrinsic and extrinsic value? We can get into the weeds. This is going to be a weekly thing.
Yeah, let's get into that. But real quick, the 17.5, I want to minus the 72 cents in premium you got, which means your cost basis technically is 16.78, which is still lower. I mean, still higher than the current market price. So
correct. So here we're in the hole. There's no
Right.
way around it. Right now, if it was January the 19th right now and we took ownership of these shares, we're in the hole temporarily, because immediately I take possession of these shares, we would enter into another spoke of the wheel, and that's where we would sell a covered call against these shares to bring in more premiums, more than likely more than what we would be down on the shares initially.
Right.
But that's a conversation for another day. But just to plant the seed, you follow me?
100%.
Because what we're trying to do here is we're trying to manufacture the win. So that's an example where you can sell a cash secure put on a stock that you're bullish on. You can pick a strike price if you're okay owning these shares. But Mr. Market's going to say, hey, I'm going to call you on your shit now because you entered into this contract. And now we're going to show you that, hey, stocks don't just go up. Trust me, bro. You follow me? Like, that stuff's not true. Stocks go down as well. So now let's take Palantir from scratch. Let's say you're brand new and you got $1,500 and you're like, how much will you pay me to own 100 shares of Palantir? How much will you pay me just for agreeing to buy 100 shares of Palantir? Let's just say a month out. That way we have an easy mathematical equation for ROI. So you're gonna go to trade options, and you're gonna put your cursors, your icons on sell and put, because you're selling the cash secured put. And then you're gonna pick the expiration date. So we're gonna go 30 days out. So February the 3rd. 3 days below my birthday, in case if anybody wants to send me, YouTube paraphernalia, because that's my alma mater. And I need help because I'm still licking my wounds. I couldn't go live on YouTube. I was crying, so we lost the game the other day. So anyway, so there's $15 right there, Amit. So let's walk through it. The market is saying, hey, I will pay you $42 today if you are willing to tie up $1,500 for 1 calendar month, and you will have the obligation. Here's the difference in terminology between buying options, guys, and selling options. When you buy options, you have the right to either buy or sell those shares. When you sell options, you have the obligation to buy or sell those shares. You see the difference there, Amit?
Yes. Yeah.
They're paying you premium, so that doesn't give you the right, that gives you the obligation.
Correct.
When you are paying premium, you have the right, not the obligation. You follow me?
Exercise it. We're correct, 100%.
So
we're getting 42 cents for $1,500. So that's a 2.8%.
$42.
Or sorry, $42. Right. So that's a 2.8% premium essentially we're getting. Is that good 30 days out to make about 3% on your money?
Well, once you multiply it times 12, we'll do the math here. I'll pull up the calculator and I'll show them how to do the longhand math. I know you know how to do it as well. Your mom was a school teacher, I believe, a math teacher as well, right?
She was, but I still suck at math, unfortunately.
Yeah, but I know how to do this math because this is the important math that makes you money. So we can look at it. We can look at it and see whether or not, hey, that makes sense, or we go study the technicals a little bit. Let's go look at the 50-day moving average. Let's go look at the 200-day moving average. Maybe we can up the ante and get a higher percentage, a higher rate of return if we agree at maybe 15.50 instead of 15.
But in general, would you think, even if you take that 2.8% premium and multiply it by 20, 30, I guess, do you like getting a 2.8% premium, or you generally want 4 or 5%?
Per month, I'm looking, ideally, I like at least 3%.
Okay, gotcha.
4% is great. But with Palantir, because it's a higher caliber company at this point, in other words, the risk of it going to 0 is very, very minimal. Even 12 it's probably just not going to happen. There's just too many buyers, dude, just go look at the open options, dude. There's so many walls at $15 right now. Like, there's so much money that has already set, because there's called limit orders. Like, are y'all familiar with limit orders? Give me a thumbs up on the channel or say yes if you're familiar with limit order. A cash secured put, instead of entering into a limit order where you're just parking your money there, not getting any money aside from the cash sweep, here you're getting paid to wait it out.
Right.
You're getting paid to essentially agree to buy the dip. In layman's terms, that's a cash secured put.
I think that's a great way to describe it, 100%. And so you're saying there's a lot of limit orders, meaning people that have said, hey, I will buy 1,000 shares at 15 if it gets there, so they can go do whatever the hell they want. And then if Palantir falls 15, their brokerage will be like, all right, you said you would buy it at 15. Here you go. And that's what would stop it from necessarily getting to those really, really low levels that you're talking about.
So there's a real good question on the chat, Amit, if you want to pull it up. How are premiums taxed?
Yeah, let's talk about that.
As ordinary income.
By the way, thank you to 200 people for being here on our first episode. It means a lot to me and TJ every single week on Tuesdays, not Wednesdays. We had to do it today because TJ had some issues yesterday. But on Tuesdays, 6 to 7, we'll be discussing everything about options. Go ahead, TJ.
So premiums are, again, I'm not financial advice, not a CPA, blah, blah, blah. Consult your tax professional. I don't want to go to jail. Okay. So just throw that out there. It's not financial advice in bunny ears. Now we're okay. Let's talk about it. So premiums are taxed at ordinary income. What does ordinary income means? It's short-term capital gains. So it's going to be 60% long-term and 40% short-term. I've never gone into this detail on my channel because I don't think anybody cares. They're just copying my trades. But on your channel, I'm going to take my time. So that's how they're legitimately taxed. It's a 60-40 split. 60% long, 40% short. So, and it's all based on your income bracket. So I'm not taxed at your income bracket because I happen to make a little bit more money than you right now.
Wait, so you're saying that 1 month 2.8% premium, that $42 we looked at, those $42 get added to my yearly income and then get taxed according to the amount of income I make, correct?
Facts.
Okay. Now, what if it's if it's a 2-year out cash accrued put, that would be a long capital gains based tax.
No. All premium, and you can Google me, call me out, guys, because I do this for a living, okay? So I'm not saying that I know everything, but I know this because I hate Mr. Uncle Sam. Hate him. I never even have an uncle named Sam, so why do I got to give him all this money? They're taxed as short-term capital gains, all of them. The only thing that can go from short-term to long-term gains is actual equities, underlines.
Correct.
And those go after you own them for 1 calendar year. They will go from short term to long term, and that gives you a tax break. It's a pay raise. So it pays to hold stock longer than a year.
Can we look at some expirations that are more juicier, or some premiums that are juicier, either based on the price or the time? Can you show me different?
Yeah, absolutely. So let's talk about my beloved SOFI. Is that fair?
Yeah, let's do that.
In fact, this is one that I'm looking to sell tomorrow. And ideally, guys, you want to sell a cash secured put on a stock that's bleeding out. Red.
Well, why is that? Why on red days do you want to sell these puts versus on?
Because the premiums are juicier. Because if you're going with the trend, have you ever heard the trend? The trend is your friend.
Yeah.
Okay, so in a cash secured put, if you want to maximize your premium, you want to sell into the fear, right? You want to sell a cash secured put.
Right.
When it's red, because the premium is going to be juicier because there's a higher risk of quote unquote assignment. There's higher risk that it's going to breach your strike price.
Right. If SoFi is going to $12, it's harder to convince the market to give you a premium that it's going to go back to 6 versus if it's falling 14% to $8, maybe it goes to 6.
Right. Because there's right now, the reason that SoFi is tanking, because there was a report from an analyst that said, hey, $6 price target, y'all are crazy, short squeeze. They're still not GAAP profitable. And, the dumb money started selling. Let's just call it what it is, right? So the shorts took control of the stock again over the last day and a half. Yes or no?
Yes, basically. Yeah.
Because there's some very popular YouTubers that were touting $50 a share. I'm like, bro, we're in the wrong business. I need to go sell what you're smoking. I can be a millionaire. Just give me some of that, and I'll go tout that. Have a YouTube channel. So if I go into 50, smoke this. You know what I'm saying? Like it ain't gonna happen, bro. Not in the next, couple of years anyway. SoFi's gonna have to earn its way there. So let's get into it real quick with SoFi, guys. We can enter into agreement that says, hey, here you're gonna go trade options. You're gonna go sell put, and we're gonna take that same 30 days. And just look at the difference in the caliber of the company, because life's all about risk reward. So now SoFi is saying, hey, you tie up $800 a minute for 30 days, I'll pay you $67. So that's called PPD, baby. That's premium per day.
That's an 8.3% premium.
I know, it's pretty awesome. And you've been covering SoFi for a while. With the way the story is, Anthony Noto, the fundamentals, GAAP profitability is literally around the corner. Dude, $8 with the 67 in cushion, which is going to bring you to what, 733 where I went to school?
Oh, that's
going to
good
be your
math.
break even?
That's good math, sir. Yeah, you're right.
that wouldn't be the worst break even. That's probably better than most of the people doing the SoFi Weekly podcast as far as an entry point. True story. And they did all the work for you, bro. They've done all the work for you. You know that SoFi is legit. You can watch 4 or 5 of those podcasts, and you're going to know a lot about this company. And you can position yourself to get paid handsomely up front just for agreeing to buy SoFi at a pretty decent entry point a month down the road. So it's a very defensive play, but it's an easy way, or it's a very simple way to generate a pretty good chunk of change up front if you're not quite ready to pull the trigger. So when do I use a cash secured put? Let's talk about the psychology of it. Fair enough, Amit?
Let's do it.
Let's minimize this and let's talk for a second. Because again, I'm trying to put my knowledge into you so that when I exit stage left from YouTube, which won't be too long from now, you can run with this ball and I'll just be a guest once a week if you'll have me. Fair enough?
Fair enough. And I think a lot of people, the 175 people watching it, will enjoy some of this knowledge on them as well.
Let's say you're still forming an investment thesis on a company like SoFi. The way that I look at it is, why not get paid to do a little bit more research? Why not get paid to do some due diligence? We already know, just looking at it from a sheer wholesale retail perspective, we know that $8 where I went to school is better than the $8.33 that it's currently trading at right now. And on top of that, if you're willing to pay me $67 up front, I'll tie up the $800. I'll go to work. I'll play librarian for a little bit and then see whether or not I get really, really bullish. And then maybe I can make a decision to just buy the shares outright, start selling covered calls, play the other side of the wheel, and I can bring premium that way. But then I can position myself to participate in some capital appreciation as well, the upside of the stock. That's right. The downside of a cash secured put. The only money you can ever make is the premium that they paid you to enter into the contract.
Right.
So if SoFi goes to 11, you missed a boat. If Palantir goes to 20, you missed a boat. All you made was that measly premium. Those are the gimmies and the gotchas. I'm trying to show you all the good, the bad, the ugly, and the indifferent. Fair enough?
What is the benefit to getting that measly premium if it does run up? How do you manage your psychology if the sucker runs and all you did was get the premium?
So for me, I'm excited because I'm always playing both sides of the fence simultaneously. Because like on Palantir and SoFi, I already have positions that are established. I'm just playing a game called bringing premium through the door so I can lower my overall adjusted cost basis.
Right.
So I'm going to enjoy one side of the coin. Like I can't lose both simultaneously. But let's just say that you're just building, you want to build out a position with SoFi, and you enter into this cash secured put at $8, and SoFi goes back up to 10 because everybody realized that price target was full of crap. You follow me?
Right.
Then there's nothing to stop you from realizing that $67, $68 that they were paying you up front. And then the following month, enter into another contract, but instead of at $8, you can increase it to $8.50. Maybe you don't pick up another 67, but you pick up another 30 or 40. So you can get paid for following the stock up indirectly just by simply moving up your strike price. You can indirectly participate in capital appreciation. But the benefit of doing so, if you're still unsure of the stock, is that you're still technically in a cash position.
Correct. Because you have to deploy
it. That's getting paid a lot more than your sweep.
Right. No, that makes a lot of sense. I mean, that makes a lot of sense. I think the big thesis I'm getting out of you is if you are uncomfortable in fully establishing a, let's say $20,000, $30,000 position in a stock, if you start with $2,000 and you sell some cash secured puts, you tie up some capital as you're learning about the company, maybe your thesis changes while you're learning and you can get out of it. But as you're learning about it, if you really like that thesis, instead of just buying it outright and then having to deal with the emotional, swings of buying a stock, you can just get paid to wait and do as much research before you decide to fully get in. And then if you get assigned, then you get assigned on it.
My big thing, a cash secured put, the way that I like to summarize it is this way. It's when you're unsure of what an ideal entry point is, because maybe you're not the best at valuing a company,
right?
Especially one like SoFi that isn't profitable because it's not as cut and dry. Whenever a company is profitable, guys, you have PEG ratios, you have PEs. There's a lot of other metrics. It's almost like going and valuing a house in an established neighborhood because you're going to have a bunch of comparables, right?
Right.
whenever you're dealing with an unprofitable company, it's like trying to value the first house in a brand new neighborhood. It's very, very tough because you don't know what the true going rate is going to be. And the last thing that anybody wants to do is overpay for a stock because you could be bag holding for a very long time.
Correct.
So to me, while you're formulating the investment thesis, it's a lot safer. It's defensive. If you're a little bit unsure, but you want in, it's a way to participate, get a little bit of money, and then just play a game of wait and see how it goes. See how comfortable you are. Because the minute you hit submit and it gets filled, your contract gets filled, it's going to give you a feeling, Amit, and you're going to really know whether or not you're pretty bullish on this stock or you're not.
Right. Right, because once you get that contract filled and you are obligated to have to potentially buy 100 shares, you start to really think, well, I better know if I really want these 100 fucking shares.
Right.
We were talking about SoFi, Michael. We were talking about that. Here's a good question. Jonathan says, do you reinvest the premium you get from Mr. Market and you pay taxes out of the other monies you have, or are you setting aside this premium in order to eventually pay taxes?
I deal with my taxes one time a year. At 6 o'clock, baby doll. I deal with my taxes one time a year. I want to control my money as long as I can because I'm selling cash secured puts, bringing premiums through the door, selling covered calls, bringing premiums through the door, rolling options, bringing that premium through the door. And then I'm taking those premiums and selling more options or buying other shares outright. So I'm just working with the money. At the very end, I'm going to have a tax bill and I got to treat it like my job. When I worked in the oil field, when I had a cell phone company, an ADT, a home security company, a dating service, I had to pay my taxes, and what were you going to do? You could cry and complain, but you still have to pay your taxes. So it's the same thing that I do here. I cry and complain like everybody else, but at the end of the day, we got to pay our taxes.
Right. Dominic, we'll talk about Greeks on a whole nother episode. That requires a lot more.
There is one Greek that we will talk about right now, and the ideal Greek that you want to look at here. Can you put this back on the screen, please?
Yeah.
Okay, super. So here they're paying us $67 to tie up $800, but it's a 48 delta. What does that 48 delta represent? In layman's terms, it's your chances in percentages of whether or not these shares are going to get put on you. And in this case, it would be 48%. So it's literally a coin toss. You feel me?
Why does it say negative? Is that a negative near the delta or?
Yeah, it's just the way that they're represented. But forget about that. The real number it's 48 cents. For every dollar SoFi goes up and down in share price from where it's at right now, the anticipated move on the delta is 48 cents. So if it goes up $1 further away from your strike price, you gain 48 cents in this option right away. So let's talk about something really, really good on an option. Let's just say that you enter into this contract at 834. They pay you the $67 up front. And SoFi goes up to 934 a day after. You can realize 48 cents or $48 of that 67 right away. And there's nothing to stop you from buying to close this option a day or two from now and pocketing 80% of that premium that they paid you up front and freeing up the collateral. It's very important to understand that you do not have to be in this contract for the entire duration.
Right. Yeah, and we'll go way deeper into the Greeks on probably episode 2. I think that's a great the topic to really start discussing.
I think what we could do, Amit, and let me know if you think it's ideal, is we're going to go through all the aspects of the wheel, and then we're going to really dig into the weeds.
Okay.
So 3 or 4 episodes, cash secured puts, cover calls, the art of rolling, etc. Then we do a little bit of technical analysis, and then that's when we can introduce the Greeks. We don't want to give them too much too quickly because you can get inundated, dude. I mean, I've been studying the wheel strategy going on my 4th year now.
Wow.
And I feel like I'm barely coming into my own in some of these aspects. Like really understanding open volume interest, level 2 data, options walls. I mean, dude, it's a lot of shit. It's kind of like Palantir, bro. Like, how much more do you know about Palantir today after doing 500 episodes on Palantir or 1,000 episodes on it versus when you were first farting around with it, trying to see whether or not you want to be a YouTuber?
Right.
You know a lot more about the company now because you've covered it so much, right?
Right. Okay, last 2 questions for you. Is this the market condition that we're seeing right now? A little bit of a sell-off. Market ran up in November, December, where you want to be buying options or selling options? I know you're always selling them, but what do you kind of think right now?
Man,
or does it depend on the stock at the end of the day?
Man, it's so hard because macros affect certain companies in different ways, right? Like the world goes to shit, that's actually probably really good for Palantir
Right.
because of the type of business that they're in. But if like interest rates were to skyrocket, it hurts companies like Tesla and Phase because they're
SoFi.
very
Yeah.
dependent on the consumer being healthy.
Right.
With SoFi, if you got a bunch of customers that you're counting on paying loans, very, very high interest rates, high unemployment could really affect those companies adversely, right? In a negative way.
Right.
So it just really, really depends on what your comfort level is. Again, the reason that I like to sell options is because I don't have to be correct on a direction of the stock. Like, let's go back to this options chain real quickly. If you can indulge me just a little bit here. Guys, you have a 34-cent buffer there. So where else can't be right when you buy an option if the stock price doesn't go in your desired direction. When
Right.
you sell an option, you can still realize the entire amount of the premium. Even if SoFi goes from 834 to 801, you can still keep the entire premium. And you were totally wrong on the direction of the stock.
That is correct. But if it does go down below 8, you are technically wrong on the direction, right? Because you didn't want it to really go to like 730 if it gets there.
I'd be okay. An ideal scenario, to be honest, for me, is if it went down to like 775.
Right.
That would be a
Right.
real nice sweet spot because the premiums that I receive puts me at like 733.
Correct. Correct.
It's trading at 750, so I've already got a built-in profit there.
So you're saying the benefit of that cash secured put versus like if I think SoFi is going to be 15 by XYZ date, SoFi, the company, Noto, they got to really execute to get that sucker to 15. Versus if I'm selling the option, even if it gets lower, I have so much, or I theoretically have enough premium that the delta between the current price, the strike price, and then the price where my cost basis would be if I add the premium to what I'm getting is a significant window where I don't really lose as much versus if it doesn't get to 15, I lose in the
Right.
context of buying the call.
It's just a margin of safety.
Margin of safety.
It's
Right.
all it is in actuality.
Is that Noto? Is he calling? Is he
It's my
pumping the
buddy
stock?
Roland. Let me call you back, Roland. Let me call you back. So it's just a margin of safety because I believe that SoFi is going to 15. I don't know when.
Right.
So in the interim, I think right now it's pretty bearish right now. If you look at the technicals, if you look at the news, the market sentiment, I always look at the M's. I look at the moat, the management, the market conditions, the market sentiments. How do the macros affect it? Like the M's tell you a lot about a company.
Right.
And look at the money. So are they making money? Are they losing money? Hand over fist, etc. What's their situation? What's their runway? What's their burn rate? Like there's a lot the M's can tell you about a company. And right now, if you look at the M's, the management's great. You can argue whether or not they even have a moat. I kind of think they do with Galileo and the quality of their customer. That's a little bit of a moat because they chose quality over quantity. But market sentiment kind of trumps everything because you don't invest in a vacuum.
Right.
So I think the chances of SoFi going down right now in the short term are a little bit higher than it going up. So I wouldn't want to position myself with buying a call right now. I could potentially entertain the idea of buying a put, but what if you're wrong? Why
Right.
not just get paid to sell the cash secured put? And if it goes up, you win money. If it goes down, but it doesn't breach your strike price, either way, you got paid up front. I just want to have more ways to win than to lose. That's what it comes down to for me. I'm playing the percentages.
And in a market that is universally described as a casino, if you have more ways to win than lose, everyone always loses. But if you have more ways to win, you have a better probability of not losing, which is
Agreed.
a good way to do it. I got one more question for you before that. TJ's channel in the chat. Thank you, 176 people for being here. Please, please, please make sure to subscribe to his channel. He's very transparent on that channel. He's managing millions of dollars. I think you guys will enjoy his updates on that channel as well. Last question for you, TJ. What is the common pitfall or mistake that people make when selling cash secured puts, and what would you want to avoid completely if you're just getting into this game?
It's definitely what I still suffer with. I'm a recovering premium holic. Sometimes I will bypass technicals. I won't study the fundamentals as much as maybe I should. I won't even halfway formulate an investment thesis. More, forget about formulating an entire investment thesis. and I would just start selling cash secured puts on a stock because the premiums are really, really juicy. And then I find myself in the hole managing a cash secured put, and it's on a company that I didn't want to own to begin with. So the genesis of all your problems when selling a cash secured put is when you enter into an agreement to buy 100 shares of a stock that you're not legitimately okay owning. So if you can avoid that and not be premium drunk and sell cash secured puts on good solid companies that you believe in, I really don't see the downside if you're already legitimately wrong if you're legitimately long these stocks. Like I am long Palantir. What does that mean? I truly think it's going to go to a quarter. It's going to go to $250 billion, 250 billion. That is my bull case for Palantir by like the year 2030, guys. So not that far in the distance. So I want to be a part of it. So if I get put a bunch of shares at 1750 or 17, in the larger scheme of things, does it really matter? And then the cool thing for me is, well, I got paid along the way to take some calculated risks. Because before I sold options, all I did was buy shares and hope that they went up. And then I had to figure out when was an ideal time to sell those shares. And it was just a very, very tough game, Amit. So I needed to bring some monies in along the way so that I could stay in the game long enough to quote unquote manufacture the win.
No, that makes a lot of sense. That makes a lot of sense.
So I've got a couple of questions for you, Amit, before
Okay.
we finish our first pod.
Let's do it.
Have you learned anything today? A. B. What can I do to be a better teacher for you and for your audience? Because, guys, here's the thing. This pod isn't about me and it's not for me. It literally is for you. I make enough money, thank God, in the stock market that I don't have to do this shit, and I'm going to live a pretty good life with my beautiful wife. But God put it in my heart to want to give back to people because I feel like we're all trying to figure out how to win in the market. I've already got something that works for me, and I'm hoping that I can give a little something to you that works for you. So what can I do better besides shut up and listen and not interrupt and all those things? What can I do to be a better teacher and a mentor to you if you'll allow me to be those things?
Well, number one, yes, I learned a lot today in cash credit puts. I obviously had a baseline understanding of this stuff, but I think when it comes to the markets, it's a reason why people consume Palantir content every day or SoFi content every day. It's because as much as you don't always know, especially when your stock goes upside in an extreme way or to the downside in an extreme way. So I think when it comes to understanding the psychology for why you sell a cash secured put, that's something that I have a greater appreciation for because, yeah, you're right. At the end of the day, the probability of winning is significantly higher when you're playing with derivative contracts like options, which is a risky game to be playing in if you are selling versus if you are buying. So I think that makes a lot of sense. And in terms of being a better teacher, dude, I'm not just saying this to inflate your ego. You fucking know your shit. I mean, there's a reason 180 people stayed here for 52 minutes. You know how to talk about this. It's like me with Palantir. It's like if you get me talking about it, I'm going to talk about it for 5 hours. You know how to talk about this. You know how to use the examples, and I think just keep doing what you're going to do, and it's going to keep being what.
Awesome. So I want to plant the seed. Whenever you sell options and it doesn't go your way, you can reposition yourself and get even more money to in other words, you can renegotiate the contract, so
Correct.
to speak. And that's roll, and that's another episode. But if you take ownership of those shares, you can enter into a covered call contracts. So we have multiple ways to generate income because at the end of the day, the mission is very simple. You want to own 100 shares of Palantir, but what if I told you if you did this methodology long enough, you could own those 100 shares with other people's money by collecting more premium than you would ever have to pay for the shares.
Right.
So in other words, a goal would be to ultimately collect more than $1,500 in premium because I'm comfortable owning a lot of shares of SoFi and Palantir with other people's money.
100%.
That's the mission.
Sense. It makes a lot of sense. I hope everyone got some knowledge from this episode. If you didn't, leave it in the comments. We'll address them next. We'll probably respond in the comments. We'll also address them on the next episode. Next week, Tuesday, 6 to 7 Eastern, 5 to 6 Central. We're talking about covered calls. So this episode was cash secured puts. Next week will be covered calls. And TJ will be sharing his positions, all that stuff. And we'll keep going further and further there.
Awesome, Amit. Appreciate you, my man.
That's it. This was awesome, TJ. Thank you all for being here. Please make sure to like, please make sure to subscribe. TJ's channel is in the description. And again, TJ is someone who's dealing with a lot of money, so he knows what the hell he's talking about, and he knows how to communicate as well. So this is going to be a fun series. Thank you, TJ, and we'll see you guys next week. Bye, everyone.
Appreciate you guys.